Hello, everyone. This is Faiza Raza. Today, we will be starting the level 4, semester 2, week 1 lecture. So in this lecture, before starting, I have provided a brief introduction about the course, what the course is about, because finance is like a new module to the students. So I have provided a brief introduction about the course. First of all, I've gone through the Moodle. Okay, so Moodle content, Moodle handbook, the handbook which is present for students um, for the information about the course. So then again, I've gone through the professional expectations, what students can expect from this course with respect to their practical career. And I've discussed about assessment criteria, how they will be assessed for this module. Then I've gone through the lecture schedule. So what would be the lecture schedule week by week? What kind of materials, what kind of learning outcomes we'll be going through week by week? We have discussed that. I've discussed a little bit about self-directed learning. So assessment, I've told them about the assessment, which will be 3 hours of on-campus exam. So starting with the lecture, what is accounting? So accounting is the process of identifying, measuring, recording, and communicating information. So there are basically four parts of accounting definition, you can say. So which are of course identifying, measuring, recording, and communicating information. So then what would be the stakeholders of the business? Okay, so in that point I've discussed the difference between stakeholders and shareholders of a company. So then this characteristics of accounting information that is provided to the stakeholders. Basically, that should be relevant. Relevant information should be provided to the stakeholders. Then basically relevance means that it can be past a threshold of materiality. Its omission might adversely affect decision making. Then faithful representation. So faithful representation of the information, like the statements, like the financial information which is published, which needs to be published, must be faithful. It must not be having any kind of ambiguities, any kind of false information. So information represents actually not substandard transactional events. Be complete, accurate description, neutral, and free from error. So it should be free from errors. So then accounting quality, the quality of the accounting is basically comparability. It can be compared, it must be comparable. Okay, verifiability, it must be verified. Verifiability, you can say that the actual and the progressed, or you can say expected values must be verifiable. Then timeliness, if a company is doing its accounting cycle or accounting procedures on weekly base on sorry periodic basis, like some companies do on half annually basis, some companies do on annual basis, or some companies do on quarterly basis. So your statements, whatever however you are publishing, however you're publishing your financial information, must be on timeliness basis. Okay, must be on timeliness basis. Okay, so understandability, the information which you are publishing must be understandable, must be according to IFRS standards. So then we have discussed branches of accounting. So there are basically two branches of accounting: financial accounting and managerial accounting. So financial accounting is basically all about presenting the financial health of an organization to its external stakeholders. It must be correct. It must be like often has legal requirements. So The scopes of financial accounting are basically record financial transactions, summarize information, prepare financial statements, interprets financial information, communicates all outcomes, and determines financial position of a company. So next, the second branch of second branch of accounting is basically managerial accounting. So the managerial accounting basically focuses on current and future trends and is for internal use, can be tailored to focus on predictions, forecasts, investment decisions. So basically management accounting, there are perspectives of management accounting which are basically budgeting. So managerial accounting is used for budgeting, for forecasting, planning, problem solving, decision making, cause and effect, cost accounting, and performance analysis. So these are all perspectives of managerial accounting. So there are basically a few comparison in between management accounting and financial accounting. So with respect to primary users, managerial accounting or management accounting is basically for managers, employees, supply chain partners, and financial accounting is for owners, stakeholders, leaders, customers, and government agencies. So with respect to report format, management accounting are basically flexible, driven by users' needs, and financial accounting are based on generally accepted accounting principles. Then with respect to purpose of reports, the managerial accounting provides information for planning, control, performance measurement, and decision making. Whereas financial accounting provides information about reports on past performances. So with respect to nature of information, the managerial accounting objective and verifiable for decision making. More subjective for planning relies on estimates, confidential and private, which is like, as I told you, that it is basically for internal use, internal purpose. So for financial accounting, objectives and verifiable, publicly available data. So nature of information must be publicly available, okay, in financial accounting. So units of measure for managerial accounting are basically monetary at historical or current market or projected values, physical measures of time or number of objectives. And for financial accounting, there are basically it is measured on the basis of historical and current market values. So with respect to frequency of reports, so prepared managerial in the management accounting, the reports are prepared on the need basis, okay, whenever you need. So that can be periodic on the periodic basis, and that cannot be on the periodic basis. So with respect to frequency of reports, financial accounting, in the financial accounting, the reports are prepared on periodic basis. It depends on however the company is making their the company is winding up their periods, okay. So is there is the company is doing their accounting procedures on half annually basis or quarterly basis or annual basis. So on that basis the financial reports are prepared. So we have discussed what is self-directed learning. So basically, it is a critical review of questions. So it would be tackle the questions by referring back through the slides and the core text, complete your answer, and then refer to the solutions presented in the core text. So basically in during the week 12 to week 14, there will be a case study provided to the students, and they have to solve that case with respect to the modules, with respect to the learning outcomes covered in throughout the previous weeks. So this is basically self-directed learning. And what is financial accounting? Financial accounting seeks to quantify, interpret, summarize, and communicate the financial transactions of a business for the use of external and internal stakeholders of a particular organization. So it basically focuses on recording, analyzing, and reporting. Then concentrate on the knowledge and understanding required to analyze and evaluate financial statements rather than how to record everyday transactions bookkeeping. So by using standard recording and reporting formats, financial statements information can be presented in a way which is less open to interpretation and more secure. So overview, basically it is for cash flow. Okay, we need to identify that like how much cash is coming in the business and how much cash is going out of the business. So basically it is about cash flow in the business and cash flow out of the business. So wealth generation, of course, through the financial statements, they need to like the company need to identify what is the profit or what is the loss they are incurring during the accounting period. Then accumulated wealth, they need to identify because it is like assets, it is all about assets, liabilities and equity. So they need to identify what are the accumulated wealth they are generating throughout every period. So the main financial statements are basically three. There are three main financial statements, which are income statement, previously called trading and profit or loss account. Then the second is statement of financial position, which is also called as balance sheet, and the other is cash flow statement. So, okay, so then we have discussed what is the main relationship between the income statement and what is the different like what is the relationship between three of the statements. Okay, so in the statement of financial position, at the beginning of for example, this is an example, this is a whole like graph which is created. So taking it like statement of financial position at the beginning of 2021, in that income statement and cash flows made, which are used for and okay, which are used for which gives you the value at the end of 2021. Okay, so the ending balance of income statement and the ending balance of cash flow statement is used in the next year's opening balance. Okay, so basically how it works, we make income statement. Okay, so the income statement, out of income statement we get profit. Okay, so during the process of making income statement we get profit. So the profit which we calculate from the income statement is consequently going to the balance sheet. Okay, as a retained earning. So retained earning or profit. So this is how income statement and statement of financial position, or you can say balance sheet, is connected. Okay, so the cash flow, which is same as like the cash flow which we are calculating throughout throughout the period, the ending balance of the cash flow is basically the opening balance of the next year's a statement of financial position. Okay, so this is how they are interlinked. Okay, so next we have discussed, okay, statement of financial position. What things are included in statement of financial positions? There are basically three parts of statement of financial position, like balance sheet. So there are three parts of balance sheet: assets, liabilities, and equity. So assets, basically those assets are those an economic resource held under control by the organization, not a public good, and capable of measurement in monetary terms. So that must not be you can say intangible. Okay, so all of the assets are okay, in the assets there is categories as well, like which are current assets and which are non-current assets. We have discussed current and non-current assets as well. So in current assets are those who are held for short term, less than a year, and for sale consumption, principally held for trading and will convert to cash quickly. Okay, so those assets who can be converted into the cash very quickly, and who can be like kept, who can be held as short term or less than a year. So those assets are current assets. For example, stock inventories, like there is another name of stock which is inventories, or debtor owing, or you can say accounts receivable or cash. So these are the examples. So non-current assets are basically, the other name is fixed assets. So fixed assets are basically held for a long term, for operations purposes more than a year. Okay, which are basically property, plant, equipment, like whatever laptops or whatever things we are using in the office. Like, okay, so and land also covers in that, buildings. So these are the basic examples of non-current assets. So next, the other part of balance sheet is equity. So equity is the owners, investors, directors provision of funds into the business. Okay, so whatever the partners or whatever the investors, owners or directors are like adding in the business their own money is basically equity. So liabilities, external parties for which a past transaction requires a financial settlement, current and non-current. Okay, so these are basically also, they also are current and non-current liabilities. Okay, so accounting equation is basically assets equals to equity and liabilities. Whenever you are making balance sheet, so you must balance assets equals to equities plus liabilities. Okay, so as this is basically an example of STL, Jerry and Co. Accounting, you can say balance sheet. Okay, so for the day two inventory, they have like made that balance sheet. Okay, so this was an example we have solved in the class. And then financial statements. Okay, so statement of change in equity, note to financial statements. We have discussed those things. Accounting periods, we have discussed accounting periods. What the accounting period is basically usually 12 months with a designated accounting year end. This does not have to be the same as the fiscal financial year end. For example, 5th of April or calendar year end is 31st of December. So it doesn't mean that it must be like the same as the fiscal or accounting end for the business. Okay, so income statement refers to activity over the accounting period for the year ended. Statement of financial operation is a snapshot at the start and end of an accounting period. Okay, so this is a layout of statement of financial position. Basically, at first, the heading, the title, balance sheet for the year end, whatever ending period you are having. And then first we have to calculate fixed assets, then current assets, then it will go to total assets. Then you have to calculate current liabilities, then long-term liabilities, then it will proceed to total liabilities, and then in the end you have to balance the assets and total capital and liabilities. Okay, so uses of statement of financial position is basically it shows how the business is financed and how these funds are deployed. It can provide a basis for assessing the value of the business. It can identify the relationship between assets, liabilities, and equity can be assessed by this. Then liquidity and capital employed, equity plus non-current liabilities can be better assessed. Okay, so the analysis for the stakeholders is basically for interest of different okay, it is basically the useful for stakeholders, and it is the basis on the basis of statement of financial position. Short-term and long-term decision making can be easier for a business, and then it is open to interpretation. Goodwill need to compare to industry and previous balance sheets, then it can be manipulated. Okay. So afterwards, we have discussed accounting conventions. Okay. So there are some of the accounting conventions that likewise business entity convention, historical cost convention, prudence, going concern, and dual aspect convention. So basically business entity convention is owners are treated as being separate and distinct from each other. Okay. So this convention applies to all types of business, not just those which are also legally distinct from their owners, such as limited companies. Then historic cost convention is assets are showing on the balance sheet at a value based on their historic cost. Okay, so but the depreciation, the reduced value over the life of the assets are also calculated and shown in the balance sheet. So prudence convention is caution should be exercised. Profit are not recognized until realized. Okay, but expected losses are often accounted for even if not yet certain. Okay, so we have gone through a Tesco case study as well. So going concern convention is basically financial statements should be prepared on the assumption that the business will continue to operate normally for the foreseeable future, unless this is known not to be true. So the next is dual aspect convention is every transaction, whatever is going on, must have double aspects, or like less minimum they are having two aspects of recording. Okay, so accounting standards, we have discussed accounting standards, which are a guideline for publication of the financial statements. So there are few accounting standards which are like international accounting standards and international financial reporting standards. So okay, then in the end, we have discussed the summary of the lecture. This is all about today's lecture. Thank you so much for listening. Thank you.